IAS 10 events after the reporting period establishes the accounting principles for events occurring between the reporting date and the date when financial statements are authorized for issue. These events can significantly affect financial position, profitability, and users' understanding of the entity's financial circumstances. The standard ensures that financial statements reflect relevant information available before authorization while maintaining consistency and transparency in reporting. IAS 10 distinguishes between adjusting events, which provide evidence of conditions existing at the reporting date, and non-adjusting events, which relate to conditions arising after the reporting date. Correct classification is essential because it determines whether financial statement amounts are adjusted or merely disclosed. This distinction supports faithful representation and improves the reliability of financial reporting information. Adjusting events after the reporting period are events that provide additional evidence regarding conditions that already existed at the reporting date. Because these events confirm circumstances present at year-end, entities must adjust recognized amounts in financial statements accordingly. Examples include settlement of court cases confirming existing obligations, bankruptcy of customers indicating receivable impairment at reporting date, discovery of fraud or accounting errors, and determination of asset impairment conditions existing before year-end. Inventory sales after the reporting period may also provide evidence regarding net realizable values at reporting date. Adjusting events ensure that financial statements incorporate the most accurate information available before authorization, thereby enhancing reliability, completeness, and faithful representation of financial position and performance for stakeholders and investors. Non-adjusting events after the reporting period relate to conditions that arose after the reporting date and therefore do not affect amounts recognized in the financial statements. Because these events did not exist at year-end, entities do not adjust reported figures. Examples include major business combinations, destruction of assets caused by natural disasters occurring after reporting date, significant declines in market values arising after year-end, and announcements of restructuring plans initiated subsequently. However, when non-adjusting events are material, IAS 10 requires disclosure of the nature of the event and an estimate of its financial effect if practicable. This disclosure helps users understand significant developments occurring after reporting date that may influence future operations, financial stability, or investment decisions despite not affecting historical financial statements directly. A particularly important issue addressed by IAS 10 is the treatment of dividends declared after the reporting period. Dividends proposed or declared after the reporting date are classified as non-adjusting events because no present obligation existed at year-end. Consequently, such dividends are not recognized as liabilities within the reporting period's financial statements but are disclosed appropriately in notes. This treatment reflects the principle that obligations arise only when formal authorization occurs. IAS 10 also addresses going concern considerations, stating that if events after reporting date indicate that the going concern assumption is no longer appropriate, financial statements must not be prepared on a going concern basis. This requirement ensures that financial statements remain realistic and informative regarding the entity's future viability and financial sustainability. The date when financial statements are authorized for issue is crucial because IAS 10 applies only to events occurring before that date. Authorization date varies depending on legal and governance structures, but generally occurs when management or the board formally approves financial statements for publication. Events occurring after authorization are not considered within IAS 10 requirements, although entities may voluntarily disclose extremely significant developments. Determining the authorization date accurately ensures consistency in evaluating which events require consideration. Proper application of IAS 10 therefore depends not only on understanding the nature of events but also on identifying the precise reporting timeline and assessing whether events provide evidence relating to conditions existing at the reporting date or emerging afterward. Overall, IAS 10 provides a structured framework for distinguishing and accounting for events occurring after the reporting period. By separating adjusting and non-adjusting events, the standard ensures that financial statements reflect relevant year-end conditions while also informing users about significant subsequent developments. Adjusting events improve the accuracy and reliability of reported figures, while disclosure of material non-adjusting events enhances transparency and decision usefulness. The standard also reinforces critical accounting principles such as going concern and faithful representation. For DIP-IFR candidates, understanding IAS 10 is essential because post-reporting events can significantly affect asset valuations, liabilities, profitability, and stakeholder perceptions. Proper application of the standard supports high-quality international financial reporting and informed economic decision-making.